Morning, Justin.
Good morning.
Great to see you back in Australia again.
Glad to be here.
So let's look at credit markets to kick off. So credit spreads look still pretty tight. Defaults are fairly manageable at the moment. How are you seeing opportunities in the market at the moment?
Yeah, we think today's market really sets up well for long-short credit investing. There are two opportunities in the market that rarely exist together. The first is the ability to get significant current income. Normally, when you have an environment where you have low spreads, low defaults, credit investors have to accept a very low current income. However, given high base rates, we're able to create portfolios with north of 7% yield to worst in both bond and bank loan markets. The second opportunity is also a robust shorting environment. If you look at today's environment, the S&P 500 is up 11% year to date, yet triple C's and high yield are flat, and triple C's and bank loans are down 3% year to date. That's a very rare occurrence where you get equities up and the lowest risk part of the market down. What it's telling you is there's a big difference between the type of companies that are in the equity market and the credit market. And the fact that the credit market has a lot of leverage with a lot of technological dislocation means that you're going to have much more dispersion as we move forward. And so that's a really interesting environment to create additional return through shorting securities when you have these tight spreads.
So in some of your strategies, Justin, you've actually reduced your exposure to loans. Is that more a reflection on sort of short-term things like LME, increase of LME, or is it more around more long-term technical issues around the sector?
Sure. So when you look at the bank loan market, just like high yield, the technicals of the asset class are actually quite strong. CLO formation is robust. We're seeing a lot of new issuance in that marketplace. But as you mentioned, we have taken our bank loan exposure down, and that really relates to the risk profile of the asset class. If you look at over the last 10 to 15 years, bank loans have gone from 47% double B, the highest quality part of that we can have from a ratings perspective, all the way down to 30%. So a 1,700 basis point decline in the lowest risk part of the market. At the same time, the reason that happened is because private equity has really leaned into bank loans and private credit to fund their investments. If we look over the last 5 years, private equity has spent most of their time in software and technology. And as a result, private credit and bank loans have an excess amount of that type of risk. As technology risk picks up, it seems to us that that risk profile is going to lead to a lot more volatility. When you add on LME or liability management exercises, as prices come down, there's a higher risk that you will not be able to recover because there will be liability management that occurs before you ever get the chance to recover. As a result, we've taken down our exposure as we wait to watch some of that play out.
So moving into the tech space, a lot of AI investors to date really look at investing in that sector from an equity lens. Shenkman, however, think that this represents a significant opportunity for credit markets. So can you talk a bit about that?
Absolutely. So as you mentioned, AI is growing in terms of the capital that it is requiring across all asset categories, whether that be equities or fixed income. If you just look at the investment grade part of the market, AI now represents over 15% of the entire investment grade credit market. So it really is getting financed everywhere. As we look in high yield specifically, just year to date, we've had over $30 billion of issuance for data centers. That represents approximately 20% of all new issuance. That has come from different companies with different structures, which makes a very robust investing environment. In addition, those names have actually added to the yield of the overall asset class. So from that perspective, it's really a positive. We're getting more yield with a lot of new companies. However, we know that technology is going to create a lot of uncertainty, and credit likes certainty. So when you have the mix of the two over time, that's likely to create a lot more price movement as we digest all this technological dislocation. And so that will create more opportunities for fundamental investors.
Shenkman is very experienced in investing in stressed credits. So how can you tell the difference between what is perhaps a short-term stress compared to sort of more long-term fundamental issues in the sector?
Yeah, so that's always the challenge in our environment is how do we do that? And it all first starts with deep fundamental research and knowing your management teams. We spend a lot of our time getting to know the management team, so when something goes wrong, we can call them, we can really try to understand what it is they're facing to try to differentiate between that something that's going to happen and that's going to be quick to recover or something that's going to take a long time. Now, in addition to that, what we're really looking for is where you see wide selling that occurs usually over an industry where investors are not differentiating between the companies in that industry. As an example, we just saw that earlier this year in the software space, where in bank loan software, we saw really that whole sector trade down in the February-March period, right in front of a very large CLO conference. Because no CLO manager wanted to go to that conference saying that they were overweight software. So we saw mass selling of that space regardless of name. If you were really comfortable with the names you owned, you could then pick between which names were oversold and which names maybe justifiably were down. We still see those opportunities quite frequently, and that's really when we want to step in and use our capital.
So to expand on your last point, Justin, in a market that's heavily influenced by passive funds, quant analysis, rapid changes in sentiment, as an active manager, how can deep fundamental analysis really provide gains in the space you play in?
Yeah, well, where we are today, as we were talking about earlier, all-time tight spreads. It's really about that fundamental research where you can make a big difference in portfolio management. For the last decade plus, a lot of investing has been beta, the overall market up or the overall market down. Now that technological dislocation is affecting industries in different windows of time, it's going to be a matter of really understanding those companies, understanding how they're going to handle these technological changes, and then being able to differentiate between them. That's where you're going to start to see a lot of dispersion among managers. In fact, you're already starting to see that in the private credit space, where you're starting to see those managers that thought about portfolio construction and those that didn't. And that is already creating differentiation in the private space. That is just going to flow through to the public space over the next 24 to 36 months as technology continues to affect many companies in our market.
So Justin, we're sitting here again in 12 months' time. From your perspective, what is the current consensus view that people are going to look back and say, we got that wrong?
So depending on where you are in the world, consensus views are often different. I would say here in Australia, oftentimes in meetings, everyone's expecting high yield spreads to widen. I've heard that over the last 3 or 4 years. And I think in 12 months' time, we will still be here and spreads will not have widened. The reality is that nearly 60% of the high yield market now is double B. And many investors, when they do their historical analysis, are comparing a market where double Bs used to be 40% of the market. And so we've just moved to a much more defensively oriented market. That doesn't mean it won't sell off if you have macro sell-offs, but it's unlikely to have a sell-off that is broken away from overall equity markets or overall risk markets. And so in 12 months' time, I think we'll